Let's start with the first topic, R&E post-OBBBA. Now, research and experimental expenditures changed. When TCJA said, was it 24, 23 was going to, we had to start amortizing, 22, we had to start amortizing them, and everybody said, Congress will fix that, right? We're all going to get that fixed, no problem. You will not have to amortize those expenses. Let's start with the first thing, is when we amortize the expenses, Mark, how do we distinguish how long to amortize those? The TCJA expenses.
So yeah, when TCJA came in, we had to start capitalizing and amortizing our domestic R&E expenditures over 60 months. So we were looking at, in 22, 23, 24 returns, we already had these on our depreciation and amortization schedules.
Yeah. So, and that was for domestic, but international?
International's 15. Anything that wasn't, and funny the way you guys say it, it's not international. The way they define domestic research and experimental expenditures is anything that's not foreign.
And what was interesting is that my practice is in Silicon Valley, and most of my clients that did R&E, we're not doing them domestically. So that was a big hurt. That was a big hurt. Now, Tom, what's going on now? What are our options at this point?
So thanks to the One Big Beautiful Bill Act, new Code Section 174 Cap A for 2025 and future expenses allows a full deduction for domestic R&E. Foreign R&E continues to be amortized over the 15 years.
Okay. Now, I do believe that we can do something for those couple of years in between. And Dave, do you want to jump in on this one?
Well, we've got a few options. There are some retroactive elections which need to be made decisions on quickly within the next few weeks. You have the option of taking all of the unamortized expenses in 2025. And if I'm not mistaken, you can also make an election to take them over 2 years. One of the things that gets factored into this is, especially with regards to 2022 R&E expenses that you're already amortizing, is you're already coming up on, at this point, a good portion of the class life has already been amortized. So the question then becomes, does it make sense to go back and amend any prior years to claim those expenses?
Now, I am going to, Mark, and feel free to say, you know what, Alan, you're going off the deep end here. But or I'm even completely wrong, and believe me, folks, I've been doing this for over 36 years. I know nothing about taxes. I'll be the first to admit it. But I remember something about partnerships being able to amend returns versus doing a administrative adjustment, or do they have to do administrative adjustment to recapture that?
So there is a special set of rules for small businesses. For 25 returns, that would be 31 million or less in average annual gross receipts for prior years. You can go back on the R&E expenditures and actually amend prior returns to get rid of this whole capitalization and amortization rules. The problem with that, and for partnerships specifically, I don't think they called them an AAR. They allow actually an amended return here, so they're not making you go through the AAR process, which is a little bit different. But that deadline is rapidly approaching. It's July 6th. If you're not done by July 6th, that option no longer exists. At that point, you're doing change in method of accounting and 3115s or statement in lieu and a 481A adjustment or cutoff method. So yeah, but there was that special rule for partnerships. They don't have to do an AAR.
Great. So you got 3 weeks to go back and make sure all your partnerships are done. And for those of you that don't do the partnership return, you may get a client with an amended K1 that you were not expecting because of that. So I just wanted you to have a heads up on that. And of course, that is a deadline also depending on how far back this was going. If it's going back to 22, that amended K1 could potentially be in jeopardy if they don't bring it in until next year sometime, as far as amending returns, right? Just as a little side note. Anything else you would like to add on this conversation before I move on to the next topic? Tom has got his hand up there.
Yeah, I just want to say that what we're talking about are choices in the tax law. Do we make the retroactive election? Do we deduct all of the remaining amortized amounts in 25? Do we spread them between 25, 26? This is a planning opportunity, folks, right? And so we need to quantify what the benefits are of each approach, because one may be significantly better than the other. So for example, if 25 income is way higher than the prior years, that deduction may have more value in 25.